Hello, everybody, and welcome to Commodity Culture, where our goal is to make you a better investor in the commodity space. My name is Jesse Day. As always, standard disclaimer, nothing here is investment advice. Do your own due diligence. And today's guest is a professional investor and economist with over 30 years of experience and the president and founder of Pento Portfolio Strategies. We're going to discuss where he sees the global economy headed. We're going to talk about the stock market, how he sees commodities positioned, and more. It's Michael Pento. Great to have you back on the show.
Great to be with you, Jesse. How are you doing?
Doing excellent, thank you. I want to start with just getting an idea of what's on your mind right now. You can take this in any direction you'd like, but what are you watching when it comes to financial markets and the global economy that you think investors should be paying attention to right now?
Well, due to the events this morning, you mean other than World War III breaking out? So I believe Iran is going to retaliate with the ICBM. And how many, I don't know. And believe me, I am not purporting to be some kind of military expert. I'm just running scenarios most likely in my mind from what I know, limited knowledge that I have about geopolitical sphere. So they retaliate like they did last time, but except this time they might have some bigger warheads and maybe more success, maybe not. I don't know. They're going to do something, and I think they've telegraphed that move, so Israel has enough time to, using the Iron Dome, can shoot it down. But then Iran saves face. That'd be the best case scenario. That'd be a best case scenario. But then you give Netanyahu that leeway there. He's going to take it, and he's going to, launch, I think, a very, very specific strike on Iran's nuclear capabilities and destroy some of their oil infrastructure. So I think the price of oil, if I'm right about that, and I wouldn't take a huge position in it, I think the price of oil could be going higher. We could talk about commodities later. And then you have the port strike now, which is, I have to say, today we got news on the ISM manufacturing survey. So 22 of the last 23 months, the manufacturing sector in this country has been in contraction. Did you know that? I mean, were you aware of that, Jesse?
I was not.
Okay. But if you listen to the news, the regular news stories, they say, well, the U.S. is onshoring and we're building these plants and we're going to be the chip manufacturing center of the world. And that maybe happen someday. It might happen someday. But right now, the manufacturing sector, which is the goods, part of the goods producing sector of the economy, and making stuff is still kind of important because we're not spirits, we're physical beings. That's contracted for 22 of the last 23 months. As a matter of fact, if you look at the ISM, the actual number was in contraction. I think it was 47.2 or 46.2. I don't remember exactly. But what I do remember is the subcomponent of the employment index was shrinking at a faster rate, 43. So, we're actually firing workers at a faster pace in the manufacturing sector. So that's on my mind. And then why I mentioned that is because we have a port strike going on now. So dozens of ports across the Gulf and all the way up the East Coast are closed. If this thing lasts for several weeks, you're going to have a manufacturing depression. We could be in a depression now. Almost 2 years of contracting manufacturing is pretty bad. But you hear stories. Well, but the Atlanta Fed says GDP is growing at 3% for Q3. Really? With the manufacturing sector of the economy in a recession, depression for 2 years, and we're growing at 3%. You sure you're not just measuring inflation? I'm not too sure about that. I think they're just mismeasuring inflation. That's what I believe. But here's the point. You asked me about the economy. The economy is weak. It's not very strong. It's very imbalanced. We have massive bubbles, but we're getting counteracting that or offsetting that as a ballast is stimulus from the Federal Reserve trying to cut short-term interest rates by 50 basis points. At the same time, they're shrinking their balance sheet, which is a difficult trick to do. You're printing a bunch of money, a credit, flooding the Fed funds market with reserves, And then I guess you're sterilizing those reserves on the long end because your balance sheet is supposedly shrinking, and it is shrinking. So, okay. The reverse repo facility is almost emptied now, but you have a lot of money in the TGA. So a lot of cross currents right now. But the bottom line is inflation has gone from 9% to 3%, the way the CPI measures it. I don't think it's going to go much lower outside of a recession. I don't think there's much room left in the bond market to rally. So yields can't go much lower outside of a recession or World War III. And you have, I think, a secular trend of very, very weak growth. That's my prediction. So stagflation is what I see as the most likely scenario in the long run. But right now we have somewhat of a stasis, a slight disinflation with growth that's beyond a doubt now going to contract. I mean, I think Q4 GDP could have a 0 or a 1 handle at best.
Hey guys, just a quick break to hear from today's sponsor, ARC Silver Gold Osmium. They offer personalized service and competitive prices with no minimum purchase for silver, gold, platinum, or osmium. Here's just some of the comments left on this YouTube channel about ARC SGO and owner Ian Everard. Have bought from ARC, good source and price. I cannot say enough good about Ian and his company. He is the most honest individual I could find in order to buy precious metals. If you are looking to buy precious metals, I recommend Ian at ARC Silver. He is a straight shooter. So go to arcsgo.com and contact Ian Everard today at 307-264-9441 or by email at ian@arcsgo.com, and make sure to tell him that Commodity Culture sent you. So I want to pull on that thread you mentioned regarding a potential spike in the oil price if the conflict does play out as the scenario that you laid out. We're recording this on October 1st. It's going to be live this week, Friday. So I think by that time, we'll probably have a lot more information to work with. But what are you seeing there? You said you wouldn't take a big position in oil. Obviously, this would be a trade for somebody who is not already in it based on potential geopolitical risk, which is always something that is extraordinarily difficult for the average investor out there to navigate. I'm just long oil anyways, so I'm looking forward 5-10 years. I think the price will be up and to the right with a lot of volatility in between. How do you see the energy sector playing out in the long run? And in the event that this war does affect global oil supply, how does that change the thesis?
Well, I'm not long base metals or energy right now. I'm just long an awful lot of gold at this moment because I don't want to buy energy in a period of time where global growth is going to be anemic. I just wouldn't do that. And because of this port strike, I could see the U.S. economy potentially grinding to a halt. I mean, you can't, cars can't be imported or distributed, and lumber and everything. I mean, it goes through these ports. There's a significant amount of the U.S. Imports and exports go through these ports. So you could have a very sharp recession if this thing doesn't work out very quickly. And I think I don't have much faith in our current administration to fix the problem. Not that it's in his jurisdiction, but so if this goes on a long time, we'll have even a slower economy than even I imagined. So in that scenario, you want to avoid base metals and energy. You want to concentrate on gold because gold will benefit from the geopolitical strife. Energy could benefit as well, but that depends on the reaction that Israel has. So that's why I say don't invest a whole lot of it. I think you're correct. If you're going out 5 years, I don't have 5-year time horizons. I don't like that because, and with all due respect to you, I mean, I manage money and I can't tell my clients, well, we're going to have 4 years of struggle, but the fifth year is going to be great. There's no reason for me to do that because I'm here every day and I have one portfolio. I have over 1,000 accounts under my purview, but I could buy and sell every day if I wanted to. So trade in and out of positions every day if I wanted to. So there's no reason for me to project 5 years down the road. But if I was to project for that far down the road, I would say the level of stagflation that we're going to experience after this round of recession, depression, wherever we're going to go through is over, is going to be unbelievable because we just don't have the tax base to fund U.S. deficits and debt and the interest on the debt. We just don't have it. The tax base is not there. In fact, our debt is over 720% of our revenue. I mean, you have an insolvent condition here in the United States, in my opinion. So debt has to be monetized forever and ever. And that means you're going to have a lot of inflation down the road. And I don't know of any better hedge against inflation than energy.
So you mentioned you are long gold. Is that the physical bullion? Is that the miners? Both? How do you see the gold sector unfolding moving forward? Why do you feel confident going long gold here?
First of all, I've been long gold for quite some time. So it's not a new position. And we have over 10% of our entire portfolio in physical gold. I don't have any miners, but they're definitely on the menu to be purchased. I just don't like stocks here that much. So if I don't like stocks that much, I'm certainly not going to go, into miners, which are stocks. But I can make an exception to some degree because the gold mining complexes never looked better to me. Here's the problem, and we talked about energy. One of the biggest input costs to gold miners is the energy it takes to dig gold out of the ground. That's what makes it so rare and beautiful in the first place to own, is because it's actually an element that's extremely rare. And you have to spend a lot of energy, which includes oil, to get that gold out of the ground. So if we do have a big spike in energy costs, it's not going to do well. It's not going to fare well for gold miners, but it will do very well for the gold price. So I'm not saying don't own any miners. We don't own any currently. They're on the menu. I could buy them in the future, but I feel much more comfortable and safe in just physical gold right now. And the reason is, I don't know if I answered your question thoroughly. The reason is not only because of geopolitical strife, it's because exactly what I said before in the last question. We have intractable stagflation as far as we can see. And what that involves is a government that is printing money to purchase long-term debt. That is our fate. I think we're going to look like Japan as the best case scenario, or it could look like Zimbabwe. But anything priced in dollars is going to go way up through the roof, especially gold. So gold loves falling real interest rates. So if you have a artificial cap on long-term rates, the Fed seems hell-bent on cutting interest rates on the short end. I guess he's declaring victory over inflation. Jesse, wouldn't you like to be in one of the meetings of the FOMC and say, Mr. Pento, I'm calling you. Okay, thank you, Jerome. It looks like you're now not only declaring, inflation dead and buried, you vanquished the inflation problem, even though it's way above your target still. Why are you cutting by 25? No, you cut by 50 basis points, which means you really want to get inflation higher. But Mr. Powell, it's the level of prices, you moron. It's the level of prices that has decimated the middle class of this country. What are you doing at the level? What are you doing to bring down the level of prices? Oh, no, you can't have the level of prices fall because that would really kill banks' balance sheets. Their assets are primarily mortgage-backed securities and real estate-related assets and consumer loans. And if you have deflation, that would kill the banks. So you can't do that because that's who you're really in charge of protecting. Anyway, to answer your question, yeah, gold is probably in a very long and record-breaking, historic bull market, and me and my clients are enjoying that ride.
Do you think we could see a resurgence of inflation in a serious way, going back to the Fed cutting by 50 basis points? If they continue to cut, a lot of people believe that will cause a resurgence in inflation. They're stuck between a rock and a hard place in this situation. Do you think we could see inflation with a vengeance come back? What are your thoughts there?
Well, inflation isn't the natural order of things, If you tied money to a gold standard, so if you limit the base money supply, that's what the Fed controls. They control the base money supply, and then banks can, in a debt-based monetary system, the banks control the rest. But if you had a stable monetary base, or one that went up maybe by 2% a year, which is commensurate with the mine supply of gold, you wouldn't have any inflation at all. especially if you let banks go under. I mean, if banks didn't have the liquidity to back their loans, they would go under if the loan started to go bad. So they wouldn't be so careless expanding the monetary base from the other aggregates M1, M2, and M3. So we wouldn't have any inflation. So the natural order things, Jesse, is for deflation to rectify everything. So it's going to take a tremendous amount of fiscal and monetary support to create inflation. And I think that's exactly what you're going to get. If you look at the election that's coming up, we have Jerome Powell. I'm sorry, Jerome Powell. Yeah, we have Jerome Powell at the Fed right now, but we could get Donald Trump. We could get Kamala Harris. But what I'm most concerned about is a government that's not divided. In other words, you get a clean sweep on one side or the other. So you're going to get, if Trump gets elected, you get all the tariffs, but you'll get massive tax cuts, which I believe, I'm a big believer in tax cuts, but they should be offset by spending cuts. So you're not growing the size of government. That's not going to happen, unfortunately. And then if, God forbid, you get Kamala Harris in there, you have all of her handouts that she's going to do. For having a kid, here's $6,000. You want to start a business? Yeah, how about $50,000? Here's $50,000. Oh, you want to buy a house? Here's $25,000. I mean, where's the limit? And she cannot do all of that by executive order. But if she has both houses of Congress, then it's going to be lights out. So what I hope is going to happen, and what I believe is going to happen, is we're going to have divided government. And in that case, what you could have is just the expiration of the Trump tax cuts at the end of 25. So you're looking at deflation in a big way, if that's the case. Or that'd be a big deflationary impulse that occurs. And then you just have the executive orders, say Trump wins, and then you just have a divided government. Or even if Kamala Harris wins, you're just going to have executive orders, which are limited. Thank God they're limited. So you might have the expiration of much of the Trump tax cuts.
Well, let's talk about the presidential election coming up. Obviously, one of the most bizarre and polarizing in recent history. You've kind of laid out how you see it going for the economy if either one of them was to be elected. How is this something that's investable, whether either one of them wins? Can your average retail investor out there make decisions based on that fact? Or is this a situation where you just kind of have to let the chips fall where they may and stick to your strategy?
Well, one thing I didn't mention, what I'm most concerned about is that what comes happen after the election is that we don't have a winner. We have no clear winner, no idea. And you end up doing recounts in a swing state, like Pennsylvania, Wisconsin, Georgia. You end up having weeks go by where we don't even know who won. And then when you find a winner, the losing party, ties it up in courts and contests it. That's a salient risk that happens in early November. Could happen, all the way into the end of the year, depending on, and then you have depending on the outcome, could be calls for cheating and could be violence. I mean, that's something you can't really know for sure. And you pray it doesn't happen. But the average individual, if I was the average individual, I would wait for the economic data. In my model, I have a model, Jesse, that it gets concerned because you could just be headline reading, ICBMs prepared to launch against Israel and election interference from Iran and Russia and all this other stuff. Listen, I look at the arcane components of the stock market, credit spreads, the liquidity in money markets, financial conditions, things like that's in my model. That lets me know when whatever is in the headlines is actually going to be real and what's unreal and when I have to worry about something and when I don't have to worry about something. So thank God for that model that I created because I've been doing this 33 years now. It's a long time. So it took, even a dumb guy like me, after decades, can understand, hey, listen, if you want to make money, this is what you have to look at. These are the 20, I have a 20 component model based on the second derivative of inflation in the context of the economic activity of the United States. Is it a recession? Are we in stasis? Are we growing? And those components let me know where we are in that second derivative and how the growth is coming along in the economy. Are we recessing, or are we growing? Are we reflating, or are we disinflating, or are we deflating? And then I know what asset classes work best in each scenario. Which stocks, which bonds, which currencies, and which commodities I should own. That's how I'm going to work this. So I guess to answer, just to wrap up your question, the average investor probably shouldn't go out on a limb and read too many headlines and make any decisions about what they're going to do. But if you have a good money manager with a good algorithm, you might be able to navigate this smartly, whatever happens.
Well, you employ both long and short strategies when it comes to employing this macroeconomic model you created. Could you start by telling us where else you're long right now outside of the gold sector and why?
I will. So I've been long for a while India, which has been a great, I love the demographics in India. I haven't been long China. China has not worked outside this latest sugar high stimulus from the PBOC, and the China and Beijing. So India's worked out very well for us. I love the demographics, as I said. I love the growth that's in India. Doesn't mean I don't marry any of the things I mentioned. So they're all subject to change. So this is for me, and it's not direct investment advice. So I've been long the bond market, short end of the bond market. So think 1 to 3 year treasuries, and it's been a big win for us too, because I knew back months ago that the problem we're going to have is that the Fed is going to be cutting rates pretty aggressively here, and then they've already started doing that. And short end of the bond market loves that, and that's exactly what happened. I wouldn't be in money market funds because you don't get any convexity there. You get the convexity going out a little bit along the yield curve. I wouldn't go far out on the yield curve because, at 3.6, 3.7% on the 10-year note, we're outside of a collapse or World War III, a collapse of the economy or World War III. Where is the long end going? It's going to go much higher, in my opinion, because of the inflation that we're going to create. And the inflation created from the Fed, lowering long-term rates. So I'm long a yield curve steepener. I'm also long bond proxies like utilities. So you get a little bit of the AI play and a little bit of safety in a slowing economy. So that's pretty much my, I've been long aerospace and defense. It's also been a very big win for us. And I don't think the events that are happening currently in the headlines are going to hurt the chances of making money there. Unfortunately, I wish I could sell it. I wish I can get out of it, but that's not my charter here. So that's pretty much the portfolio in a nutshell. Oh, hold on. I didn't answer your question thoroughly. I have two hedges. I am short high yield because I just don't see any way that yields can get any tighter. That particular investment has not worked out for us, but it's only 2% of the portfolio, and that could turn around very quickly. It's a very small part of the portfolio. And I also have an anti-beta investment that I hold, which basically that shorts every sector of the economy, take every sector of the economy, and it shorts the high beta complex there and goes long the low volatility complex. So you take every little sector, and it's a bet that the volatility will increase. And I think that's pretty good odds on that happening too. So that's the Pento portfolio at this point.
Excellent. Are you short the broad market, AI stocks, NVIDIA, these things at this point, or do you think that's just too risky of a play?
Jesse, the good thing about me, and if I had to, if I have to give myself a compliment, because nobody else does, is that I'm very bearish on the construct of the United States government and the markets. This economy is very, very fragile, in my humble opinion. Overvalued beyond any extent that I could ever dream of. If you look at the total market cap of equities as a percentage of GDP, which is the Buffett indicator, which I love. And if you don't like that one, you can look at price to sales. You can look at the cyclically adjusted PE ratio. I mean, it all screams one thing, that the market has never been more overvalued than it is today. So when the market's the most overvalued it's ever been, it's vulnerable to a downside. So the the good thing about me is that even though I understand that, and I don't like our deficits, and I don't like our debt, and I don't like the monetary policy, and I'm scared to death of our fiscal policy, I'm still making money in the portfolio because of the model. It keeps me long in the sectors that I think are going to do well because of the back testing that I perform, given the second derivative of inflation in the context of economic growth. And when that changes, I will go short the ones, the NVIDIAs of the world. I can't go short individually. I do it through ETFs that actually short the market for me because I have retirement accounts. Can't short NVIDIA in an IRA. But I will go short in using ETFs, a little bit of inverse. I hate inverse ETFs, but you can use them for a short period of time. I have other ETFs that I use that aren't inverse, but should profit greatly. But when the time is right, when we have a recession, NVIDIA is going to crash. It's not going to go down a little bit. I hate to disagree with Stan Druckenmiller, but I mean, NVIDIA is, their customers are corporations who use their free cash flow to purchase the chips. And when their free cash flow dries up, there won't be any money to buy their chips, and their price will crash. So it's all about timing. Yes, you can time the market. That doesn't mean you can time it by the day, but you can time the market in the sense of, are we in a recession? Are we not in a recession? Are we inflating or are we deflating? That's the timing that I do.
And you mentioned that according to your model, now is not the time to be buying energy or base metals. Outside of gold, are there any commodities that look attractive to you here? And if not, what are the indicators you'll be looking for to know when it's time to deploy capital into the commodity space?
I have to wait for the okay, so the answer is no. The only commodity I own now is gold. I do have the natural gas and oil prices on my radar. I haven't pulled the trigger yet. That could change by the time this video airs. I don't know. But I'm waiting for the economy to enter into a period of reflation. I just don't see that happening yet. We have a lot of problems to get through first. Jesse, I'm not entirely sure at all that we've avoided the recession. Everybody's talking about no landing or a soft landing. The real Fed funds rate is still very positive. You know that, right? So the reverse repo facility, which was where most of this money printed over the past few years ended up, is now almost completely dry. It's virtually run dry. So you have a yield curve that just normalized. That's every time that's happened in the past, after being inverted for the longest duration in history, you've had a recession or at least a collapse in GDP growth. So there's a lot of things. You've wiped out the middle class of this country. There's the bottom four quintiles can't afford to exist in a healthy way of eating and in a proper way of treating themselves to medical care. They can't. That hasn't changed. So I don't think all the problems are over. Once we get through that, then I think we enter stagflation, and then I'll buy commodities.
You mentioned a lot of negative points about the U.S. economy, the broad market being very overvalued, et cetera. You also mentioned India as a place where you're currently seeing value. Do you think people need to look outside of their own shores more often when it comes to investing? Because the vast majority of people in America, I think, own American stocks. The same could be said of Canadians, probably a lot of American exposure as well as Canada. Do people need to start looking at places like India? And are there other emerging economies or just places outside of North America that you're also currently seeing value? Maybe Argentina?
No, I'm not looking at Argentina at this moment. During times of a recession, you kind of want to eschew foreign markets for the most part. So there's usually a tremendous amount of dollar strength that comes in. There's a repatriation of currency trades that happens in a global recession. So I haven't ruled that out yet. And that's why at this moment, and I do have a pretty significant position in it, I think I looked at what country. I didn't have to own EEM, all of them, and I didn't have to own China. I didn't have to own Brazil, or you can't buy Russia. But I said, what's the best country out there? If I have to invest in a foreign country, and I wanted some offsetting exposure to my U.S. exposure, I said I had to buy the best, and the best is India, and that still holds true at this moment.
So there are some who have a counter argument to the fact that the U.S. economy is not in good shape. We've got a post here from X by Yanli Kuhn, a professor at NYU, who said to everybody who says things are more expensive, yes, they are. But average hourly earnings have grown faster than the consumer price index since 2020, despite the brief spike in inflation due to COVID disruptions around 21 and 22. So purchasing power has increased overall. What are your thoughts on that?
Well, I think it's actually a ridiculous a ridiculous conclusion to reach. So, if you look at average wages, they're up 22% since 2020. But if you look at the CPI, it's up 22%. If you look at CPI, it's up 22%. So, I mean, I did the numbers myself. So, and anybody can do it if you have internet access. So I don't know what he's talking about, because so if you look at real wages, they're kind of gone nowhere over the last 4 years if you deflate them by the CPI. But if you look at real inflation, like home prices are up 50% in that same duration. Car prices, used car prices up 50%. New car prices are up 30%. Insurance is up 50%. Food is up, I think it was up 37% or 38%. Food. So that's, if you use the hedonically and substitutionally corrupted CPI, it looks like real wages haven't fallen. But if you look at a real measure of inflation, which is closer to 40 or 50%, real wages have absolutely collapsed. And that is why you see, if you look at polls, that 50% of Americans don't have $500 in the bank. And 75% of Americans are living paycheck to paycheck. And one more thing. So this person is NYU professor saying nice things to get, probably saying nice things to get good vibes about Democrats to get Kamala Harris elected. The average American knows damn well that they've been eviscerated by inflation. And by the way, the average hourly wages, average, not mean, not median, I'm sorry, not median, average. So those wages have been skewed to the top side. So if you look at the more of like a median wage, I'm sure they've plummeted. So I think that answer is depraved of any kind of intellectual, what's the word I'm looking for?
Honesty?
Honesty or thought process. It's full of mendacity.
Yeah.
It's full of mendacity. And I would encourage people to look for the numbers themselves and understand that the purchasing power of the average American has been destroyed over the past 4 years.
Well, Michael, thank you so much for coming on again. Always enjoy our conversations. Could you tell us about Pento Portfolio Strategies, your weekly reality check, and where people can find out about that?
So the website is pentoport.com, and on it you'll see a URL for the midweek reality check. And this is something I put out every Wednesday. I look at the salient data that was released during the week, and I give you a good, honest take on that data. And if you have $100,000 to invest and you're a U.S. citizen, I would be glad to manage your portfolio myself in the inflation, deflation, and economic cycle portfolio.
Great. Well, I'll put a link in the description to the website for those who are interested. Thank you once again, Michael, for coming on. It's been a blast, and looking forward to the next time we chat.
Thank you, Jesse.
And thank you for joining us today. This episode was brought to you by ARC Silver, Gold, Osmium. For all your precious metals needs, head to arcsgo.com and contact owner Ian Everard today at 307-264-9441 or by email at ian@arcsgo.com, and make sure to tell him that Commodity Culture sent you. And I'll see you guys in the next episode. Commodity Culture is a series on commodities and natural resources. If you would like to see more, be sure to subscribe and hit the bell notification so you're always up to date with the latest episodes.